Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your game plan for retirement. I am Peter Rashan, joined as always by your guide, Northwestern Ohio, for a common sense approach to planning with your money, for your finances, for your retirement future. He is president and founder of Mcintire Retirement Services, Chris Mcintire, and we always appreciate your time and perspective on the program, Chris.
Hey, Peter, good to be with you. I hope everybody's doing well today.
Well, we are still paying attention to this recent bout of market volatility. Really, 2022 has sort of been a rough year, to put it mildly, Chris. On today's program, we are going to discuss the different ways that money behaves. Yes, we know that the market can go up, it can go sideways, it can go down, but how does that truly impact us? Is that the end all be all and the key thing that we need to be paying attention to? And if it does impact us, how so? So we're going to be talking about that on the program with Chris Mcintire today, ladies and gentlemen, the way that money behaves and what we can expect with our money when we are doing one of three things with it: making contributions, holding it, or creating income or distributions from it, and how that impact can compound on the direction of the market. If you've got questions or concerns, if you want to make sure that your money is behaving and doing the job that you need it to do in order to achieve and accomplish your important financial goals, pick up the phone and give Chris Mcintire a call. Set up that one-on-one complimentary strategy session, a planning review. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, there is a natural transition that occurs with our money. We undergo different phases and have different behaviors with what we are doing with money.
Yeah, no question about it. And again, we're always doing something with it. And we'll make a worthless joke out here and say those of us that are married, yes, our wives are spending it, right? And we'll get that out of the way. So jokes will get better as we go on here. And money is always in motion. I'll give an example, Peter. This year, I've had a lot of clients who are still working, who have, and getting close to retirement, though, upper 50s, early 60s here, and have said, hey, should I be putting my contributions in something more conservative as the market is very volatile here? And, generic advice that I was giving to them was, no, continue to buy stocks, because you want to buy stocks as the prices are going down. You're buying more shares at lower prices versus fewer shares at higher prices when the market goes the other direction. And, so that was kind of I'll use generic advice to most of those clients was, nope, continue investing aggressively. Doesn't mean that your portfolio can be more conservative. Again, your contributions have already been put into established places. Additional contributions may be buying on the dip, so to speak, like Warren Buffett has been doing.
Yeah. And investors may be familiar with the term dollar cost averaging, Chris. This is one of the fundamental principles of long-term financial success. And most everyone who's ever had any kind of employer-sponsored retirement plan, like a 401k, whether they knew it or were doing it consciously or not, was participating in the benefits of dollar cost averaging. But I've also heard the term recently, dollar cost ravaging or sequence of returns risk. Can you define each of those terms for us so we can start with a base level and then build from there?
Yeah, so while sequence of returns risk is been one that's been highlighted here, especially in 2022 with a lot of stock and bond volatility, is, we could call it the luck of the draw risk. So lots of clients right now retiring. We've done a lot of rollovers here throughout the spring and early summer of 2022. And, some of those folks have suffered some losses because of stock and bond prices. And, the downside to, retiring in a year where the market is negative is, the value of your portfolio is going down, and then you're going to start pulling money out of it as well. So, you got an emotional element there of taking money out of something that's falling in value. You got to have some stick-to-itiveness here, but pulling money out of a portfolio that's going down. Hopefully we don't have a big long, like a 2000, a 2001, and a 2002, a very long protracted, let's call it an economic recession, not a crisis, a recession. And, man, that really hurts when you're taking money out of portfolios while the market's going down. That just happens to be the sequence of risk. The sequence of returns is what Peter and I are referring to there. What was the other one, Peter?
Well, dollar cost averaging. On the other side of things, you spoke, Chris, about beginning to make those withdrawals or creating income while the market was down. On the other hand, a formula for success is to buy when things are cheap.
Yeah, exactly. I'm still working. I have never interrupted my contributions going in. In fact, I've upped them actually as the market is dipped because I have that flexibility. I'm self-employed. We don't have to worry about the payroll deduction or anything like that. So we can add money at different times, probably a little easier than most folks do. They just program it and set it and forget it, which is okay. Nothing wrong with that. But as the market has dipped here, especially in the technology sector or, the Facebook, Amazon, Apple, Netflix, Google world, FANG effect, we call that, is adding some more money into that sector, actually. So usually the worst performer one year, that isn't always the worst performer the next year. So adding more money, that dollar cost averaging while the market's going down contributes to long-term success when the market turns the other direction. So some of the things you do now may not be realized for a year, 2, 3 years down the road. And, most investors don't have that long of a mindset, unfortunately. And, day trading is not a strategy. That's a very, very difficult thing to do for most individuals.
Well, Chris, the Fed is beginning a direction that they have not taken in quite some time. And in fact, basically in that Great Recession 2008, they began a strategy of what was called quantitative easing. It essentially was to put more money out in circulation, make it easily accessible and cheap to get to. And now the Fed is turning the corner. They created more than $9 trillion in very low interest rates for a prolonged period of time. But the market generally doesn't like change. And the Fed is basically doing a U-turn. They're trying to contract the money supply and make it more expensive to get to. Pretty much one of the leading causes, compounded with other kind of current events and international conflicts and supply chain issues. But that is really, I believe, one of the leading causes for the volatility that we are seeing temporarily. The good news is that the market not only has always come back, has always surpassed previous highs, even after downturns.
Sure. And, and it causes the market to reset. So, monetary strategies, investing strategies that worked very well in cheap money times, okay, may not be the strategies that work the best in more expensive money times, like Peter was saying, as we raise interest rates, and I'm going to use the word normalize. As we normalize interest rates, they are not normally zero, right? Banks have normally paid us for money sitting in our checking, savings, certificates of deposit, money market type accounts. That hasn't happened for a very long time here in the United States. That's not historically normal. So again, the Federal Reserve needs to raise these interest rates to cool the inflation piece down so that prices don't get any worse than what they have been here for 2022. Let's be honest. It's been disastrous on energy, on food, on all the other commodities that are out there. And, some of that is supply chain issues. We've talked about this on previous shows, of course. It's not like, one person in the White House controls everything that's going on. They certainly can pass legislation that has some impacts, but, some of these things have been ongoing for a long time. This cheap money policy, and yes, we can point blame and say, the last thing the market needed was another injection of cash early on in this administration's, but I think that was one thing that they had run on. So they added fuel to the fire, let's be fair, and at a time when it wasn't needed. And, finally it caught up to itself. And a lot of people have been, Harry Dent's been talking about this forever, right? Mm-hmm. As, hey, you keep adding this much money, eventually inflation's going to get out ahead of itself. And it certainly has. It, is a shock to the system. We're at a 40-year high basically on inflation right now. So the Federal Reserve are raising interest rates, and that pushes down the prices on bonds. So, you take April, for example, the NASDAQ here was down 21% in the month of April. That's brutal. The S&P 500 down 13%. The Dow finished down 9% for the month of April. That's a tough month that can get to any investor's mindset. I'm an investment advisor. It gets to my mindset. No question about it, guys. And then all of a sudden you've got bonds that are down about 10%. So like, where do you run and hide, so to speak? And sometimes you just have to weather the storm, right?
And yet, Chris, the age-old wisdom for how to deal with those downturns from Wall Street, from the financial industry, has been, well, you haven't really lost money unless you sell. And I would go the other direction with that, or ask rhetorically, is the other direction then not also true, that we haven't actually made money unless we sell? And I think that can be illustrated with a couple analogies. One with this housing market. Everybody was kind of euphoric that the value of their home rose 25% in what seemed like a 12-month or an 18-month period. But unless you sold your house during that time, did you actually make any money? Or the second analogy could be, going to a Vegas casino. If you play your first hand and you're up, you've turned $1,000 into $1,500. Did you actually make any money if you keep playing and then you cool off and you start losing again, right, Chris? And is the same thing not true on both sides of the equation when it comes to our investment portfolio as well?
Yes, because we all get greedy when the market's going up. They're like, nope, I'm going to stick in there a little bit longer before I rebalance, or before I bring in a safe money strategy, for example, that we've talked about on previous shows here throughout, the last 10 years. It's easy to get greedy. And then when the market goes down, it's easy to get needy. I need to get safer. The market's down at the bottom, and investors' behavior is fueled by emotional decisions that typically tell them to do the wrong thing at the wrong time. And, when the market's up down low like this, you read the Wall Street Journal, go back and Google, what's Warren Buffett doing right now? Buying like crazy. That's what he had been doing after the sell-off.
Yeah, and, I heard to the tune of tens of billions of dollars in purchases.
Yeah. Yeah, he's a smart guy, he's well positioned. Obviously, he's got, the capital to do so. But that's what investors need to do. That's why rebalancing is important as well, Peter. So, when the stock market is down, you rebalance your portfolio to take advantage of some of those lower prices and ease an economic cycle to, we give the roller coaster analogy to make it more of a gradual hill, if you will, that you're climbing. Nobody wants to climb to Mount Everest and fall off the edge. We want to descend nice and slowly if we're going to come down. So having a portfolio that is well balanced to do that, there are times, there are months or quarters where that can seem like it's a big challenge. And, the first part of 2022 would certainly be one of those, but it certainly wasn't any panic mode or anything like that to happen. Yep. We're going to have some issues here with supply chain. We're coming out of COVID that's killed 6 million people, for crying out loud, guys. There's, that has certainly upset the economic apple cart, and it takes time to get that back in order. I think as we look forward here toward the month of November, we got some big elections that are going to be up and coming. So I think you're going to see, so many TV commercials, we're all going to get sick of them here, but, that's going to change some of the legislative outlook. It certainly looks like the House and the Senate could go to the other party, to try to stay politically neutral here. And, usually the economy does pretty well when we have different parties in power here, actually, instead of just one, to be honest with you.
Well, if you would like to have that disciplined approach with your money to make sure that you've got a plan in place and that every dollar is working its hardest to help you achieve and accomplish your important financial goals, pick up the phone, give Chris Mcintire a call, have that conversation, set up a convenient time for that complimentary review, that forensic financial analysis of your accounts, and that planning strategy session. Chris can help you map out your goals and make sure that your dollars are working to help you achieve them, and that you understand the risks that you're taking along the way, the fees that you're paying, the taxes that you may be liable for, how to translate and transition the lump sum that you've saved into an income that is sustainable and dependable for retirement. These are all of the things that Chris addresses during that planning review and strategy session, how to make the most out of valuable tools like Social Security, how to optimize that and include it as part of your comprehensive plan. All you need to do to take advantage, a complimentary service, an extension of the education of this program, is call 800-868-1194. That's 800-868-1194. 800-868-1194. Now, Chris, as we began the show, we talked about the fact that we were going to discuss the different behaviors of money or with money. We know that the market can be moving up, it can be moving sideways, or it can be moving down during given periods of time. We also know that we've got three potential directions that our money can be going. We can be contributing, we can be holding, or we can be distributing or creating income. And what we are doing, compounded with the direction the market is taking, actually has big impacts in the end results that we will achieve. We really need to understand this as we are looking at different opportunities to make sure that our dollars are working hard to help us achieve our financial goals.
Yeah, it certainly is. And, in full disclosure, people don't know that Peter is a spreadsheet master, and he has created a nice spreadsheet here. Yeah, and it's wonderful. But it talks about a down market, a sideways market, and then an up market. And so, since most of the people listening to the show are old enough to remember the 2000, 2001, 2002 recession that we had, combined with the shock of the terrorist attacks there of 9/11, the market, the S&P 500 fell about 46.5% there when you can kind of cherry pick the peak to the trough there. Okay. That was in 3 years, negative 46.5%. That's a deep recession. Okay. So if you go from 2000 to 2010, that entire period that included the 2008 financial crisis, the market increased 6.71%, the S&P 500, over a 10-year period. So it went sideways, okay? Then you take 2009 to 2021, and it went up 172%. So, folks, if you're trying to, that's one hell of a roller coaster. We went down 46%, we went sideways 6.7, and then went up 172% in 21 years. Talk about a roller coaster. That's why you need a well-balanced, well-diversified portfolio, a safe money to help you ride through some of the storms or the chop on Lake Erie, if we want to put an analogy in it now that it's boating season here. When we know storms can blow up quickly here on the lake, they can as well in the financial markets, as we've seen through at least the first quarter of 2022. So, sometimes you got to take a deep breath here, and you're going to have to ride through some of these things for long-term financial success, and do some things that Peter and I talk to you about on the show here every week.
Now, this is using the real world returns of the S&P 500. And ladies and gentlemen, numbers sometimes aren't translated well over radio, so we'll try to put the chart up on the screen. You can certainly call and request this chart so you can see the impacts that these factors that we're going to talk about will make on your money. It is a very eye-opening chart when you look at the difference that occurs whether you are contributing money over a given period of time, simply holding that money, or taking distributions. So again, if you would like that complimentary review, if you'd like to make sure that every dollar that you have the opportunity to control is working its best to help you achieve your financial goals, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. So Chris, the first first two columns in this chart I thought were pretty eye-opening with the down market period. And in column number 1, we start from scratch. We don't have any money to begin with, but we are contributing $10,000 a year. So while the market is falling 46% over a 3-year period, we are actually making contributions. We are putting new dollars in. Compare that to the second column in the chart where we are simply holding money. We start that same period with $100,000. And at the end of that same 3-year period, we actually only have about $59,000 left. We have lost a substantial portion of money. And it's not that the new contributions did not lose some value, but they were taking advantage of buying in over that time. So if we extend that out to the sideways period, by the end of 2010, when we started with nothing, we actually have $117,000 that we have built up. When we started with $100,000, we only have $85,000. That's a big difference. That is impactful to understand the difference in making contributions during a sideways market or a down period versus just having an existing life savings that we are sort of allowing to ride it out. And a lot of people have the ability to differentiate what they're doing with their money, but maybe aren't aware of this important opportunity or have overlooked this age 59 and a half in-service distribution ability.
You're right, Peter. And it gives you the ability to certainly diversify into different types of investments than what might be available in the 6 to 10 different funds that an average 401k is going to have. And you can use some low cost investments so that, more of your money is working for you as well. And, your analogy there was fantastic, Peter, because a lot of people think I'm only going to make money if I'm invested in stocks. When as we see, if you'd have put $100,000 to work in 2000, at the end of 2002, you got about 60,000. So you lost 40,000. If you'd have had a well-balanced portfolio, you wouldn't have lost nearly that much. You would not have had to recover 60% when you lose 40. Okay. And actually it's more than that. Okay. But then you go all the way out to 2010. So a 10-year time frame, and you still have less money than what you put into it. In that sideways market of investing in the 500 companies in the largest 500 companies. And, imagine if you were taking money out of it during that time frame as well. So Peter ran an analogy on this, and, we have the visual aspect. You folks out there are listening to us. And when you can see this, so if you started with 100,000 in the year 2000 and took out 4%, $4,000 a year, and rode all the way out to 2010, where, we had two big economic issues in there, you'd have $38,500 basically.
Ooh, how confident are you feeling about the next decade of retirement, Chris?
Yep.
And over
imagine
that next decade.
Imagine if you did that with $1 million and pulled out 40,000, you'd have $380,000 left in 10 years. So again, you have to use other types of vehicles to help diversify your portfolio for your own goods. And, and there's many different types. We don't have time to go into all of that. We do that on many shows. So appreciate you listening to some of these things. But, the sequence of returns, depending on money, which direction is that money going? Which direction is the stock market going? Are you contributing? Are you distributing? Is the market going up, or is the market going down, or is it going nowhere? And, we kind of heard that phrase stagflation a lot here, that, are we going to get to the point in this economy where it's just not going anywhere? That's what we would call stagflation. And that's probably a concern that's, coming across some people's radar here. Look, are we cooling this economy too much where we're not going to go anywhere? And again, some of that will be driven off of the supply chain issues as well that we're dealing with in China. Because unfortunately here in the United States, we buy so much of our goods from them.
How, Chris, does that in-service distribution opportunity allow folks to sort of differentiate here with given scenarios, allow them the opportunity to better control their outcome?
Yeah. So, at 59 and a half, they have that triggering event that allows most people to access part of their 401ks to do a in-service rollover or a distribution that's tax-free, or not taxable, I should say, a non-taxable distribution into an IRA. And they can look at many different types of investment vehicles out there, from completely safe to, a nice managed risk portfolio, to commodities, to commercial real estate pieces that they can invest in, that, that mutual fund portfolio that they've got 6 or 7 choices in just isn't going to do for them.
So, Chris, when we have a life savings built up and we have already contributed and built up that amount versus the new dollars that we're putting in, the ongoing contributions, we can actually specify how those dollars are differentiated, what job they are to perform for us. And this is a critical opportunity in the process of retirement readiness, because if we're adding $400 per paycheck to our 401k and then the market falls 25%, hey, we lost $100, and the next contribution that we make, we're actually taking advantage of lower prices. But if we've got $400,000 that's built up in that 401k account and then the market corrects 25%, that's a substantial loss to our life savings, and we're not really taking advantage of those downturns in the market the same way. Same's true for old 401ks that are left behind. These are why people need to have a plan in place and specify the job that each and every dollar is doing.
Yeah, correct, Peter. And, you may want to start building your income plan for your retirement before you get to retirement. So those are some things that you can also do with those in-service distributions. You have access to accounts that are simply not available inside 401ks currently. You can begin to do Roth conversions and things along those lines as well. And, better when you take a distribution from a 401k, there is a 20% mandatory tax withholding. So if somebody listening to the radio show here today says, I need to take $10,000 out of my IRA or out of my 401k. Well, if you take it out of your 401k, they're going to withhold 20% tax withholding. Out of your IRA, you're going to dictate how much money you have taken out. Maybe you're in a 10% effective tax rate. Then why would you want to withhold 20 when 10 is the correct dollar amount? So it gives you a lot more liberty. It's an individual retirement account, not a group retirement plan. Probably a good analogy to talk about on the radio show, buddy.
Well, there are so many opportunities to better control our dollars, and we've got to pay attention to each and every one of those opportunities. If you've got an older 401k that you're no longer making contributions to, perhaps that should not be invested the same way. Perhaps that would benefit you to roll that over to an account that you own where you can dictate the terms and control certain aspects. If you've reached that milestone of 59 and a half, another important opportunity for you to take note in, you can continue working and contributing and capturing the match and taking advantage of the 401k, but the existing life savings that you've built up, you may have other opportunities to better dictate what your money is doing and better control your outcome. And that's why you need to understand the compounding effects of the direction that money is going and then the direction that the market is taking. And Chris Mcintire can show you how to better control that outcome and the options that you have available to you, ladies and gentlemen. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, we always appreciate their time and guidance that you provide here on the program and educating people as to the opportunities that we do have available to us to make our money work harder for us and better determine our outcome.
And my pleasure, Peter. Good to be with everybody today. Stay safe out there and make sure you're enjoying life a little bit. Thank you so much for listening today.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.